Trading the stock markets is an exciting endeavor, but it comes with choices. The choice is, do you want the high speed of day trading or do you want to be patient and pursue swing trading? Very often, it is not an either or. A trader will often wonder if they can do both. But what I have learned from experience is that typically, once you pick up a trading style, it becomes very difficult to change your mindset and apply it to a completely different trading style. In today's market, the exchange has made day trading an extremely expensive affair. And my choices, I'm willing to work hard. So my choices are not governed by effort or difficulty. Rather, my choices are governed by cost and feasibility. In today's day and age, based on how the exchange has structured the costs associated with trading and the margins associated with trading, day trading full time as a career seems almost next to impossible. And let me explain the reason for that before we proceed any further. We we would be fully aware of the whenever you enter a particular broking account, one of the things that we see is that almost 35 to 50% of all bear profitable traders bear 35 to 50% of the total profits as trading costs, which means if someone is to earn rupees 100, there is a 50% cost, leaving behind rupees 50. And then we know that trading has almost 30% taxes on profit, which means a tax of rupees 17. And in that case, finally, the trader is left with just a third of what they have actually earned. One must understand that when you take this up as a career, paying over 66% of your profits in taxes makes trading the most taxed profession in the country. And taking up a trading style which increases costs is definitely there has to be a strong justification to do that. Very often, people take up day trading simply because they want to protect themselves from two types of risks. One of them is the overnight gap, and then the other is the weekend gap risk. But it is my view that individuals who fear gaps in the India and trade the Indian markets are going to be perpetually working in the Indian markets. They will not be they will not be free from trading. So, in the long run, I certainly believe that swing trading and positional trading is the answer if the current cost structure is to continue. So, is there no application of day trading? And here my answer is that day trading is the fastest way to learn how to trade like a professional. A key reason of why I think I do better than most traders today is because of the initial time that I spend day trading. Day traders are exposed to far greater volatility than swing traders or positional traders are. And this volatility forces a day trader to have the perfect trading behavior. And when you take this trading behavior after years of it being refined in the market and deploy it on longer time frames, all of a sudden trading seems much easier and far more comfortable. And the only thing that you're managing are your own growth and risk expectations. The fear of the security doing something is largely factored in your position sizing itself. So if I were to start my trading career today and if I had less than 5 lakh or 10 lakh rupee trading capital, I would certainly day trade. But the idea of day trading would not be to make money. The idea of day trading would be to actually learn how to be a better trader. In that context, I would then take my learnings of what I learn in the day trades, that is on the hourly charts and 15-minute charts, and use that on longer time frames in order to build stronger systems. Since I will have so much more time to analyze the market, I will create a wider watch list, much wider than just Nifty Bank Nifty, and expose my positions to a lot of stocks simultaneously. When we run large number of trades parallelly, what happens is that we remove or eliminate the role of risk in determining the outcome of that trade over a long period of time. Of course, one needs to be lucky at an individual trade level from time to time, but The individual will also be unlucky, and this will balance out as your trading career progresses. But the key is to have a lot of positions open simultaneously. And the math behind those positions are actually outlined in the course links that I have highlighted in the description box. So we'll continue with our process of mechanically analyzing the market, because as a day trader, let me assure you, even though visually this is very clear, very clearly a range, because we can see where the cursor is marked and where I'm marking a blue line, we will see that this is a high of a range. There is no real clear higher top on such a visual look of time frame. But because we are looking at the hourly time frame, we will never really practically find many securities which are always creating higher tops on hourly time frame. And therefore, the key is to assess the trend using mechanical indicators. And here one such indicator is of course the ADX, which we have covered in the past, and here we will see that the value is 63, which indicates that this security is trending very strong. And of course we can see this with the recent price action itself and the fact that it broke the range that we had spoken about earlier. It has undoubtedly created an uptrend for this mechanical indicator. And whenever we are trading an uptrend, the intention is to only buy the pullback. The pullback that I have mentioned is simply selecting two moving averages and choosing a 2050 crossover. By selecting these two moving averages on 2050 crossover, we'll see from the date of the crossover, the market has not given a single pullback. In other words, anyone waiting to participate in this market is still waiting for the pullback. And a lot of traders, a lot of day traders will be seeing this. So logically, whenever the market first pulls, the expectation would be that the trade would be to purchase the market. And the question is, where, at which price point would such a trader want to buy? And we can clearly see that the red line and the green line are the only points at which we as traders will act. Even though the trader would have seen the market breakout for such a long time, this is where discipline actually comes into place, where the trader will not buy at any value other than the pullback value. So the first pullback value we can see is 23,370, which is marked by this blue line. The other is 22,950, marked by the second blue line. These are the 2 points in which the trader will act. And of course, we need to have an exit point. So for the exit point, we will continue to use the trading range. So you would have read books, maybe by Mark Mineveri and others, who recommend a 7% SL. They recommend a 7% SL as a standard, as a universal number. I have no doubt that Mark Mineveri would have backtested that number on some securities or many securities and found that 7% SL from his point of entry works best for him. But if I had to give a universal indicator to govern an SL, then no doubt it would either be a ATR, a parabolic SAR, or a super trend. So here we will see that the ATR is approximately 75 points. Our last entry is going to be at approximately 22,950, which means that at 22,870 is basically where the trade will end for us. In other words, because 22,870 on the long side is basically where the trade is going to end for us, the entire trade plan will revolve around 22,850 CE. And the reason why one would long the CE is because at the time of assessment, the market is trading or trending bullish strong. So 22,850 CE would be the preferred buy on the option. And for futures, of course, we would have to buy at the levels that are corresponding to the 2050 moving average on the futures. Once you enter 22,850 CE, you would know that the entry is planned at 23,370, which is roughly 500 points above the stop loss. And to this, I would address the other question that Omkar had asked in one of the comments, that what if the stop loss is so far away that I simply don't wish to take that kind of a large stop loss? And here, through that question that Omkar asked, I would like to address the questions of many others who might have a similar question. That if the stop loss is too far away, you simply do not take the trade. And this process of not taking a trade for trades which have a very far away stop loss needs to be replicated regardless of the time frame that you choose or the index that you choose. The other question would be that for so long we have not been traded. Since 22,600, the market is nearly up 1,000 points and we have not traded. And so what good is the strategy of buying the pullback? And this is where the start of the video I mentioned that trading is an exciting endeavor, but we have to make a choice. If you are the kind of trader who's going to buy the breakout, then you would have enjoyed this rally. But I can show you many times in the chart when a security breaks out from a range and completely fails. So a trader who trades the breakout will catch a breakout rally, but that trader will also catch all the fake breaks that tend to happen in the market. Also, the trader who trades the breakout, since he or she is the first person entering the price, their frequency of taking the trades will be much higher compared to the trader who's buying the pullback. In other words, traders who are trading breakouts are generally traders who are only analyzing one or two securities, whereas traders who are trading pullbacks are generally analyzing multiple securities. The purpose of choosing a very simple method of analyzing the market, a mechanical method of analyzing the market, is first of all to free ourselves from discretion, the burden of discretion, to make the process of decision making easier, and further to continue with the process till we are fully satisfied that we have found a chart which meets our risk profile. This process of planning is the edge that you are actually going to have over 98% of the traders. This is what I mean, that in order to break even and to be minor profitable as a trader, just diligent, honest, hard work is good enough. In order to exceed beyond that threshold, other factors, particularly those related to your health, your personal well-being, financial well-being, relationship well-being, these things start coming into play. But to break even, to have minor profits, to not erode your account completely, the only thing one needs to do is to be a trader actually, and to not give in to the impulse that are created by hormones that we have discussed, that the markets actually induce through its price action amongst traders. So yes, if I were using this strategy, I would not have been traded if I were using this strategy on a single time frame technique. If I were using this strategy on a multi time frame technique, it is possible I might have got traded, or it is also possible that I wouldn't. I won't work that hard to find that out now. But regardless, once we take a decision, we have to stick by it. And what happens if the market pulls back to the 20 and then pulls back to the 50 and then comes back and hits the stop loss? Which means that such a trader would feel like an absolute fool to miss a 1,000-point rally to buy the pullback, which eventually corrected from its high of 23,700 all the way to 22,850, which means it gave away almost 800-900 points of that particular rally. So logically, when we made the choice of trading a trend, then in such a case, such a deep pullback is not a part of the trend. A trend is only strong if the pullbacks are shallow. A trend is only weak if the pullbacks are deep, but not beyond 66% of Fibonacci retracement in any case. But if the pullbacks are exceeding 77% of Fibonacci retracement and going all the way towards creating a double bottom, there is no question that this is a trend that you want to trade. And consequently, because the trader relies on the mechanical indicators to guide them into what is trending, what is not trending, their successes and failures are pegged with these indicators. And therefore, these traders have to spend time studying these indicators and all similar category of indicators in order to make themselves a better trader. Just for the interest of practice, we will have a look at a few more charts and see randomly Nifty 50 charts and see if there are some immediate trade opportunities that are available. So once again here, I've just randomly placed in Hero Moto, and we will note that the ADX is today at 25.02. Just today, it is at 25.02. This is obviously a bullish cross. Now you would note the plan to trade Hero Moto as a single time frame trader as per the technique would be pretty similar to what we have discussed. The first buy would be at around the 20 period moving average, which I will just mark with the blue line. The next buy would be at the 50 period moving average, which here is the second blue line. Third, we would identify the ATR, which is roughly 30 points. So here I will just subtract 30 points from 35.75 and go to 35.45 and mark the red line. The red line obviously indicates the stop loss. I will of course for now just remove these moving averages, creating a clear trade plan. We can already see that the closing has already happened below our entry. Such a stock, the trader would be so alert. If they go through all Nifty 50 stocks, the trader and if there is a gap down and the gap down happens at the 50 period moving average, the trader would be so alert in picking that up and look at what is supporting that gap, an entire gap before that. And yet, if that stock were to correct all the way to 35.45, the trader would have to exit because the trader knows that there is a range here, that you can see these range lows. The previous low is at 34.61 or 60, which is 100 points below this. So the trader would find this chart far easier to approach. The trader who's averse to higher risk on a single trade. I do not remember the name of the person who made asked that question, but I do remember that question was asked. So wouldn't such a trader find Hero Moto much easier to approach than say Nifty 50? And logically, if 35.45 is our SL, the trade planning becomes very clear. What is the trade plan? The plan would be to long the 3500 CE with SL of 45 points plus whatever is the time value for the day, because 45 points would be the intrinsic value. And where would we buy it? The CE would be bought at 36.30 and 35.75. Since the spot has closed below 36.30, this stock would be in your immediate watch list. And the trader would decide well in advance whether they are going to approach it as a single time frame trader or a multi time frame trader. If the trader is a multi time frame trader, the next day they are only going to set up a 15-minute chart and use the RSI to time the bottom. If not, they are simply going to place limit orders at these values in the open, 35.75 in the open, hoping for a gap down and an immediate purchase. Such a case, you would have a trade right in the open. Regardless, such a setup is much easier to trade than the setup that Nifty offered, because here we will see that the trend is just perhaps starting. It is just about, it just might be the start of a fresh long trend. We are not yet sure. The crossovers have happened in the past, but during this phase we can see that the ADX value is quite low. The crossover that is happening now is where the ADX value is becoming high. I am very confident that if a trader searches all the 15 Nifty 50 charts, they are every day going to find some stocks, or at least every second to third day, find stocks which would warrant immediate action in the open. This obviously requires some work, and therefore the process of assessment should be easier and mechanical. The idea of this video is to share one such process of assessment. This is not the best process of assessment, but it is a start, and I am very confident by start it is better than 98-99% of what people are even doing today. I know it because the presentation makes the whole thing look easier. One feels that this might not be the answer to the question of how to become a better trader, but I am very confident that that just because it looks easy, it's not that easy to implement it and to do it in real-time practice. And a lot of your personality weaknesses will be quickly exposed if you trade on shorter time frames like the day trades. So to end this presentation, I would say that the sole purpose of day trading as of today in today's environment is to teach you how to trade. Whenever you decide that it is time to commit serious amount of money, serious amount of growth is what you're looking for, at that point in time you must figure out a way to enjoy the gaps that are a natural part of the Indian trading market. I hope this video has helped you in some way. Have a good trading week ahead.